Jeff, you may have heard there's been a little bit of volatility in the market of late. What are we doing to protect our clients in this volatile world that we live in?
Well, luckily for us, Greg, the market provides us with a bunch of different tools that we can use to deal with volatility. Through the use of derivatives like options and futures, we can both take advantage of rising volatility and provide clients with protection from rising volatility in their portfolios.
You mentioned derivatives. That seems to have somewhat of a negative connotation. It seems like that means they're taking on a lot of risk. I know actually we use them for less risk. Can you explain?
Yeah, so derivatives can in fact be speculative. They can be dangerous if used for those purposes. But at the same time, options and futures, that's what we prefer to focus on, the risk management part.
Can you give us an example of how this cap and cushion, as we call it here at Lido Advisors, works for our client portfolios?
Sure, so we've been placing that trade for quite some time now. And the way it works is it provides our clients with a certain amount of upside if the market goes up. Let's say 10% over 13 months. So if the market's up 10% over 13 months, they're going to get all of it. If the market's up 11% over the next 13 months, they're only going to get 10. In exchange for limiting that upside, what we provide is a significant downside protection. So if the market's down, say, 10%, they're not going to lose any money. 15%, still not going to lose any money. Right around 20%, they're still not going to lose any money. Below 20%, if the market's down 21%, they're going to lose 1%. And that's something that's helped us take advantage of the volatility for our clients and provide them with significant protection.
So it sounds to me, from a layman's perspective, you're able to basically buy insurance for our clients at a relatively inexpensive cost. Is that right?
That's correct.
To me, it's almost like a sword and a shield. We're protecting against the downside protection. Most importantly, rule number one of investing, don't lose money. Rule number two, refer to rule number one, don't lose money. I really like that. What about any other kinds of trades that we're using options for right now that you look for our client portfolios?
So something that's happened recently because of the rise in interest rates is that we've been able to place these trades for a longer period of time, and that's allowed us to not cap the upside, which is great because if the market's up 50% in the next 3 years, our clients are going to benefit from all 50%. If the market's up 60% in the next 3 years, they're going to benefit from all 60%. At the same time, there's still a significant amount of downside protection that we get to provide them. Call it around 17% right now. And if the market's down over the next 3 years, a total of 17%, our clients' principals are protected. And that's great risk management as far as we're concerned.
Jeff, that seems a little too good to be true if it's not costing the client any money out of pocket. How does that work?
Well, the way we put it together is by taking a bunch of different calls and puts, these are options, and combining them with U.S. Treasuries, and every part kind of just pays for itself, and then the end result is predetermined, so we kind of know where things are going to end up ahead of time.
Some investors are familiar with a concept called a structured note. How do these trades compare to these structured notes offered by the big investment banks?
So structured notes are similar. There are a few minor yet very, very, very significant differences. The most important is in credit risk or counterparty risk. What we use here is all traded on an exchange, which has very, very limited counterparty risk. These things settle up every day, as opposed to a structured note, which uses options and deposits that are created by a bank. And at that point, you are a secured or an unsecured lender to the bank, which means that you're accepting their risk.
So if you had done that directed trade through, for example, Lehman Brothers, a structured note, you'd be sitting there kind of saying, this is not so good.
Too bad.
So we're able to avoid that counterparty risk and be able to avoid the middleman by doing these trades directly in our accounts.
Correct. Yes, it also lets us be more flexible. We can close out parts of the trade if we think it makes sense. It allows us to add new clients. You know, if we have a structured note issued by a bank, and let's say we get 15 million, well, we can allocate 15 million. But what if we get a new client that also has the same concerns that our other clients have? They can't partake in that because we don't have any more of that structured note. Here we get to create based on what the market is telling us.
Thank you very much, Jeff.